Level 1. The first number. Wednesday, 6:52 a.m. Your phone lights up. Not an alarm, a Robinhood notification. SCHD quarterly dividend deposited, $214.37. You're on the highway, doing 65, headed to your office in downtown Austin. That money hit while you were asleep. You've got $12,000 in Vanguard, split between VOO and VTI. Every month, on the 1st, $500 auto-invests from your take-home pay. You're a data analyst at a tech company. $68,000 a year, about $4,300 after taxes. That $214.37 is 5% of what you earned this month by showing up. The rules at this level are simple. You're in accumulation mode. No asset base, no cash flow. Your employer holds something you can't replace yet, a paycheck, every 2 weeks that shows up without you having to think about it. There's only one skill to master here. Keep buying. Don't touch the principal. That's harder than it sounds. Compounding is invisible for the first 5 years. The account grows slower than your patience runs out. The cost is time. 5 days a week, 8 hours a day. Someone measures your output. Someone sets your salary. Someone can call you into a conference room on any Friday afternoon and ask for your badge back. You have zero say in that. But $214.37 planted something. You keep thinking about that number the whole drive in. Level 2. Fire your employer. 18 months later, your portfolio hits $87,000. You put $21,000 down on a 2-bedroom in East Austin and list it on Airbnb. After the mortgage, property tax, and cleaning fees, you're netting $940 a month. Index fund dividends are running about $680 per quarter. 6 months ago, you started a personal finance channel on YouTube. AdSense is paying you $1,100 a month. 3 income streams. Combined, roughly $2,720 a month. This level introduces something that didn't exist when you had a salary: cash flow timing. Each stream pays on a different schedule. Airbnb settles monthly, usually end of month. Dividends hit quarterly, January, April, July, October. AdSense pays on the 21st, but only if your balance clears $100. You start keeping a cash flow calendar, logging every expected deposit to a specific date. This isn't a theoretical exercise. Your water heater dies in February. Repair bill, $380. Your next dividend isn't until April. You need to confirm you have the liquidity, or you're touching principal. You're still employed. Take home, $3,600 a month. But you've started measuring your job differently. $68,000 divided by 2,080 working hours equals $32.70 per hour. Every $32.70 your passive income grows, you've structurally bought back 1 hour of your life. You track that ratio in a spreadsheet. You update it every quarter. When passive income covers 75% of your monthly expenses, you submit your resignation and leave 2 weeks later. You rent a dedicated desk at a WeWork in Austin for $320 a month. You set one rule for yourself: don't touch principal until passive income fully covers your cost of living. What you lose is harder to deal with than you expected. So what do? Suddenly, you don't have an answer. Not because you're not busy, because there's no job title in existence that describes what you are now. But $214.37 already started something you can't undo. Level 3. Managing the system. The first time passive income clears your old salary, it's 14 months after you quit. The breakdown that month? Airbnb nets $1,040. Dividends? $820. YouTube ads? $1,650. Plus the paid Substack newsletter you launched 3 months ago. $9 a month, 647 subscribers, bringing in $5,082. Total after taxes? Roughly $5,800. More than the $4,300 you used to take home. But this level isn't about lying back and collecting checks. This level hands you something new: the authority to make asset allocation decisions. Austin home prices are up 11% over the past 18 months. Your Airbnb cash-on-cash return has compressed from 10.2% down to 7.8%. You start pulling rental market data on Dallas and Phoenix, tracking specific neighborhoods on Zillow and Redfin. You study how a 1031 exchange works, sell an investment property, identify a replacement in writing within 45 days, close within 180, and you can defer capital gains tax indefinitely. Miss either deadline by a single day, and the tax bill comes due immediately, with interest. You also discover something nobody warned you about. Keeping income passive requires active management. A guest messages at midnight. The dishwasher is leaking. You have 2 hours to coordinate a repair, or your rating takes a hit. Rating drops, your ranking drops. Ranking drops, occupancy drops. Occupancy drops, cash flow drops. Every node in that chain is a domino. YouTube updates its algorithm in Q3, cutting recommended weight for videos under 7 minutes average watch time. Your ad revenue falls 19% that quarter. Your newsletter open rate slides from 54% to 38%. You start A/B testing subject lines and tracking the delta between two audience segments. You thought crossing that threshold meant freedom. What it actually means is this: no one can fire you, but the system will punish you for going quiet. Level 4. Managing people. Steady monthly passive income hits $14,500 2 years later. The stack. Austin Airbnb converted to long-term rental, netting $1,100. New Dallas property, netting $1,300. Stock portfolio at $310,000. Quarterly dividends around $2,400. YouTube at 780,000 subscribers. Brand deals averaging $4,200 a month. AdSense $3,100. Newsletter at 8,300 paid subscribers, bringing in $6,800 a month. You hire your first full-time employee, a remote video editor in Manila. Base salary $3,500 plus performance bonus. This level introduces a risk category that didn't exist before: other people depending on you. Payday is the 15th. That means your operating account needs to be funded by the 14th, always. You maintain a dedicated payroll reserve, 2 months of salary, sitting there, untouched. Meanwhile, your accountant reminds you every quarter about estimated taxes. As a self-employed individual, you owe the IRS on April 15th, June 15th, September 15th, and January 15th. Miss a payment, and you're looking at an underpayment penalty. Federal funds rate plus 3 points. You've also built out an LLC structure. Real estate, content, and investment accounts each sit inside a separate limited liability company, each with its own bank account and its own books. Tax attorney, $8,000 a year. Accountant, $4,500. That's the cost of keeping the whole architecture legally clean. One afternoon, your editor messages you on Slack. She asks, quietly, whether her contract will be renewed next year. Her tone is calm, but you know what's underneath it. She's in Manila. She has a kid. 38% of her household income comes from the transfer you send on the 15th. You reply, yes. 2 words. You're starting to understand something. What you control now isn't just where money flows, it's the stability of another person's livelihood. The version of you that got excited about $214.37 on a highway on-ramp. That person shares no structural DNA with who you are now. Level 5. Selling the system. Monthly income breaks $40,000 the month you launch your first digital course. It's a real estate cash flow management program. $497. Hosted on Teachable. 3 months of promotion through your YouTube funnel and newsletter. Revenue, $213,000. 428 students. After the platform's 8% cut, ad spend, and production costs, net profit $161,000. Time elapsed 87 days. The core shift at this level: you're no longer selling content, you're selling a replicable system. You stop touching edit notes, you stop responding to student comments, you hire a business operations manager at $72,000 a year. She oversees 3 contractors and 2 outsourced teams: daily operations, customer support, ad funnel maintenance. Your calendar has no execution meetings, only asset allocation reviews and strategic decisions. Your actual working hours, about 14 a week. A new asset class enters the picture: angel investing. You write a $50,000 check into an Austin SaaS startup. 4.2% equity, pre-money valuation, $1.2 million. You get into a private investor network, quarterly meetups rotating across Texas cities, members managing between $2 million and $30 million. Entry requires a referral from an existing member. There's no application. There's an unspoken rule in this circle. Nobody announces it. Everyone follows it. You don't lead with your net worth. You talk deals. You talk returns. You describe opportunities. You never name the size. Information is the currency at this level. Volunteer too much, and it signals you need validation. Needing validation is a tell. When your parents call and ask what you've been up to, you say, "Still doing investments." When a former coworker asks how business is, you say, "Pretty good." Not because you don't trust them, because a translation barrier has opened up between you and everyone you used to know. Where you are now requires a language they were never taught. Level 6. Your name isn't on it. Your monthly cash flow runs between $85,000 and $120,000, depending on where you are in the dividend cycle and the course launch calendar. Your name doesn't appear on most of what you own. The 4th property, Scottsdale, Arizona, is titled under a Delaware Anonymous LLC. You're the sole member. But the membership certificate is locked in a safe at your attorney's office in Houston. Your public market holdings exceed $2.1 million, but no single account comes close to the SEC's 13F mandatory disclosure threshold. That line is $100 million. You know exactly where it is. You stay well beneath it. You have 3 attorneys. One handles real estate transactions, one handles content IP and commercial contracts. One focuses exclusively on tax planning and asset protection structures. They don't know each other. The core mechanic at this level: you are the architect of the system, not a participant in it. Your course business generates over $600,000 in annual revenue. You haven't recorded a single piece of new content in over 18 months. The operations team maintains existing modules, manages the ad funnel, handles refunds and complaints. You hold no replaceable function inside this machine. Your only role is deciding whether it keeps running. A journalist reaches out, wants to write a profile: how one person built financial freedom through passive income. Your operations manager politely declines, not because you're afraid of exposure, because your current structure doesn't need public recognition to function. Visibility offers you nothing, and explaining your actual architecture to a general audience would require far more space than any magazine is willing to give. The cost of being here isn't anxiety, it isn't moral erosion, it isn't an identity crisis. It's a clean, structural solitude. The system runs, the money moves, but not one person in your life, including the ones closest to you, can see the full picture of where you actually stand. It's not a secret. It's a language that no longer has enough overlap with anyone else's to carry a real conversation. You're sitting by the pool in Scottsdale. A notification appears on your phone. $4,317.82 deposited. Quarterly dividend. Nobody worked for it. Nobody knows. Nobody calls to ask how your day was. You're no longer sure if this is freedom or just a different kind of solitary confinement. Somewhere out there, a 22-year-old just deposited his first $500 into Robinhood and bought 3 shares of VOO. He watched a video you made 4 years ago, back when your channel had 2,300 subscribers, back when you looked real, back when you were close to where he is now. He thinks he understands the game. He doesn't, but he will.